During the pandemic, investor activity in the residential housing market spiked to all-time highs. But as interest rates rise and housing sales slump, how are investors responding? Are investors fleeing the market and seeking returns in other asset classes? Or are investors seeing this decreased competition as an opportunity? In this video, we're going to dive into some new data that shows how investors of all sizes and all types are behaving in the residential housing market. Before we get into that, let's just quickly talk about a company out there that is changing the game in real estate called Backflip. They are flipping the script on how you invest in real estate. From finding a property to funding it, investing has never been easier than with Backflip's free app. You can pull comps, you can estimate profits, apply for a personalized loan, and whether you're a beginner or you already have a couple of flips under your belt, they have a loan for you. We're talking about 96% LTC, no upfront fees, no payments for 6 months. So check them out at backflip.mobi/BiggerPockets. Okay, so let's talk about investor activity. And before we get into the actual data and some of the analysis, I just want to mention that the stuff we're looking at today, the data in this video, is talking about the residential real estate market. This is just properties that are 4 units or fewer. I'm not talking about commercial real estate like large multifamily buildings, office, retail, any of that. That has very different dynamics and is not what we're talking about here in this video. So let's talk about the residential market. And to get straight to the point, basically investors are not very eager to participate in this market. According to Redfin, investor activity is down a whopping 45% year over year. And that is a huge number. And it is particularly notable because although housing sales across all types of buyers are slumping, they are down only 31% for that broader market. So when you look at the 45% decline for investors, investor activity is actually declining faster than the rest of the market. Now, this is important to note that, a 45% drop is obviously huge, but you have to take that in context because investor activity really spiked over the last few years. So it's coming down off all-time highs, but it is still really notable. I think if you look at the following chart, it puts a lot of this in perspective. During the pandemic, the share of residential properties that sold to investors reached all-time highs. It peaked basically at around 20% in the tail end of 2021 or the beginning of 2022. Now, if you look at data over the last couple of years, you see that the investor share has dropped, but that 45% number sounds crazy. It has dropped, but it's dropped down to about 16%, which is still relatively high in a historical context. If you look back to the Great Recession, it's basically back to where it was at pre-pandemic levels. And that is the broad trend, but there is of course variation. And I think the most notable sort of subset of this data, other than location, which we're going to get to in a minute, is by price tier. And so if you look at this breakdown, again, courtesy of Redfin, I love this breakdown here. It shows that what really happened over the last few years is that mid-price homes got really attractive to investors. You see that huge spike in that light green line come in and really explode during the pandemic, but it has come all the way back down to where it was pre-pandemic. So that was sort of like this blip for 2 years. Meanwhile, if you look at high-price homes, which is the blue line, you can see that it is up from where it was pre-pandemic, but just marginally so. It is down from its highs in 2021, but it's come down a little bit. Meanwhile, low price homes, which is really where, when you look at the data even more, you see that investors have been focusing their attention on these lower priced homes. You can see that it's still really high. 23% of market share is going to investors in those low price homes. That is above pre-pandemic level, but just marginally and down again from its peak. So it really helps to sort of dive into the data a little bit further because even though the share is down from 20% to 16%, most of that reversion to the mean or to pre-pandemic levels comes in that mid-price tier category. But so far, we've basically just been looking at the share of homes for sale. Let's actually just take a step back here and also look at just the sheer number of purchases going on, because that is what's really been declining across the industry as a whole. So as I said at the beginning, we've seen total home sales decline by about 31%. So if you just look at gross volume, total number of sales here, you can see that although the share is back to pre-pandemic levels, the total number of homes actually being purchased is below pre-pandemic levels. We are at about the level that we were in about 2016 and 2017. And this chart is kind of ridiculous looking. You can see just how quickly investors jumped into the market in 2021, 2022, probably seeing that interest rates were at all-time lows and they wanted to jump in. And now, given everything that's going on, they have retreated a little bit. So the question here becomes why? Why are investors pulling out of the market, and why are they pulling out of the market faster than normal home buyers? So the obvious thing here is, of course, the cost of capital. We've seen interest rates more than double, almost triple over the last couple of years, and this has seriously cut into profit margins for most investors. That is also in addition to more market risk than we have seen in many years. And although as of this recording in September of 2023, home prices are still relatively flat year over year. I think we can all probably agree that even if prices do stay flat or they go up, the risk of a decline is much higher than it has been over the last couple of years. And so those two things together are probably lowering investor sentiment and pulling demand out of the market. But I think it's important to remember that investor demand is falling faster than homeowner demand, right? We talked about the fact that home sales are down 31%, but for investors, they are down 45%. So by a significant margin, about 50% more, the demand is being pulled out of the market for investors. There's no real knowing for sure, but some of the thoughts I have is that basically there are always people who need to move, regular home buyers due to circumstance, whether you get a new job, your family is growing, you want to move for whatever of the million reasons that people move for. There are always reasons and circumstances beyond just the most logical, most sound financial decisions that, spur people to go buy a new home. But that isn't exactly true for investors, right? Investors are trying to chase the best yield that they can get, regardless of where they can get it. Most investors won't invest in real estate if you could get a better return in bonds or if you can get a better return in the stock market. Investors are not seeing real estate as an attractive, I shouldn't say they're not seeing as attractive. It is less attractive to investors than it was during the pandemic, and it's becoming about as attractive as it was pre-pandemic. And this is because there are some better alternatives. One notable one is bonds. I know people hate when I talk about bonds, but it is really important that the yield on a risk-free asset, bonds are considered quote unquote risk-free because they have never been defaulted on. And no investment is actually risk-free, but it is really important to know that you could put your money into a bond, get 5% return right now, 4 to 5% return, and do pretty much nothing with very low risk. And so when you look at real estate from an investor perspective, you might say, okay, if I could get 7% on a rental property, but there's considerably more risk, that's not super attractive to me. So you have to consider the fact that there are other asset classes that are competing with real estate in a way that they haven't for the last few years. And we are getting back to that pre-pandemic level where there is more parity. That doesn't mean real estate has become a bad asset class. It just means that there is more parity with stocks and bonds and real estate, all offering, I guess, more similar types of returns than they have been over the last few years, just because real estate was so attractive due to low interest rates for a while. And I think the reason that real estate has become a bit less attractive is because although rents have risen, cash flow has become severely squeezed by rising interest rates and high home prices. And we see this across the board. There are not as many areas, there are not as many deals that can get good cash flow as there were a couple of years ago, or never mind, a decade ago. That was sort of a unique time where cash flow was uniquely available. So cash flow is just a little bit harder to get over the last couple of years. And that doesn't mean it's impossible, it just means it's a little bit harder. But cash flow isn't the only way to turn a profit in real estate, obviously, but the other ways of turning a profit are less attractive as well. If you look at appreciation, we just saw this huge run up in home prices. And although home prices, no one knows what's going to happen next year, there is a chance that they will go up modestly. But it is really hard to imagine seeing these double-digit appreciation growth like we saw over the last few years. And so when you combine these two things, that's why real estate is, again, just looking more like it did before the pandemic and less like it did during these crazy times that we saw over the last few years. So I do see why a lot of investors are investing in real estate less. It's very expensive. There's a cost of capital, and a lot of people are waiting to see what the Federal Reserve is going to do. I think that's really the last thing here, is that there is still so much economic uncertainty that a lot of people are probably just sitting on the sidelines and waiting for a little bit more clarity about monetary policy, about fiscal policy, so that they can make informed investing decisions. Before we get out of here though, I do want to mention that there's a really interesting part of this Redfin study that is those who are investors, who are flipping properties, are actually still doing really well right now. The average increase in property value for a flip is 61%, which is down a little bit from the pandemic, but down about 10%. And that's still a pretty hefty profit right there. And only 3% of flips in the second quarter of 2023 were sold for a loss. So 97% were sold for more than they were bought for, which let's hope that's what happens with a flip. But that is down from 29%. Back in September of 2022, a year ago, 29% of homes that were bought for a flip were sold for less than they were bought for. So that is a really considerable rebound in the prospect for flipping. It is much harder to measure success for rental property investors. There's just too many variables. Like flipping is a little bit easier to understand, but with rental properties, you have to look at, rents, your loan, taxes, insurance. Like there's just a lot more variables, but I think the same is always true for rental properties. Like if you underwrite your deal well, if you can find a property that offers at least modest cash flow, if you can add value, you can still turn a great profit. I personally have still been making several large investments. I'm actively looking for more deals right now because even though not every deal is good right now, there's quite a lot of garbage on the market right now, to be honest. There are good opportunities if you're patient and are able to find sellers that have adjusted their expectations accordingly and are willing to negotiate on price. I'm talking about the residential housing market on a national level, and a lot of this stuff is regional. So if you live in a market where there were a lot of investors, like Phoenix, for example, you're going to see a huge reduction in the amount of investor activity. About a year ago, Phoenix was seeing, I'm just picking out Phoenix, 30%, 32% of all purchases were by investors, which is huge, a third of all properties. That's down to 17%. So that is almost half as much as there was a year ago. We're also seeing big drops in Las Vegas and Atlanta and Jacksonville. This all makes sense because these markets saw these huge surges in activity over the pandemic, and now they're basically just returning down to the national average. There are actually some markets though that are picking up in terms of investor activity. New York City is leading the way. We also see Seattle, Chicago, a few places in California. These shifts, although they are really notable because again, we are seeing investor activity decline almost everywhere, but there are these places where it's going up. The increases are pretty modest. So like in New York, for example, it went up from 16% to 18%, which is about a 10% increase in market share, but it's not this huge surge in activity or anything like that. Cleveland, for example, went from 18% to 20%. There are some markets that are still seeing a lot of interest from investors. I would love to know what's going on in your market. First of all, what are you doing? Are you planning to invest? Do you see this as a good opportunity for investment because there's less competition and perhaps some more motivated sellers? Or are you waiting to see what happens, see if prices decline, if interest rates go down? I would love to hear what's going on in your head and in your local market in the comments below. If you all have any other thoughts or questions about this video, hit me up on BiggerPockets or on Instagram. For BiggerPockets, my name is Dave Meyer, and I'll see you next week.